All right, thank you for joining me again for the second session of the Crash course. We're picking up where we left off last time. We're focusing on working capital, so FIN3702. Just a bit of a recap. Remember, FIN3702 is looking at short-term financial management. In other words, you're going to be looking at things like cash, debtors, inventory, creditors, and a few other considerations. Okay, so we left study unit 4 for this week purely because you're going to see lots of questions on the cash conversion cycle. It's something that UNISA is always going to test. Just to quickly cover the learning outcomes in this module or this unit, you'll see you need to explain what the relationship is between the different components of the cash conversion cycle. You also need to know what the operating cycle is. That's part of the actual cash conversion cycle. You need to calculate and interpret the information, and then obviously provide different strategies from a funding perspective. They also give you questions relating to the aggressive or conservative funding strategies, and then there's a discussion about profitability in terms of risk and the different trade-offs that's associated with the various strategies that you can implement when you're looking at a financial management consideration. Right, and then the last thing is obviously just to apply that in context. So you will see a long question on this. It always comes up. It also comes up in the shorter questions as well, where they might ask you to do a calculation and ask you to calculate the CCC, okay, cash conversion cycle. Right, so the first thing, just to get the ball rolling, is the introduction. So from last week, or the week before actually, how do companies generate profit? There's a diagram here just to help you, to help guide you. Remember, we had a discussion about working capital. I'm going to use this as an opportunity just to recap what we spoke about last time when we looked at those working capital fundamentals. It links to what we're looking at here. So I'm just going to kill two birds with one stone here. I'm just going to ask you, in terms of how do companies generate profits, right, and what is the general cash process? We'll revisit these two questions, but let's go back to this and just ask you about your consideration in terms of the actual cash transformation cycle. So what will a business have to do in order to create some level of value? Right, so what did you come up with? What did you consider? What did you think about when you were looking at working capital?
So I think it's to try and keep your cash cycle as short as possible.
Okay.
When it comes to debtors and inventory. So
Yes.
like selling your inventory quick,
Good.
or converting them into finished goods quickly.
Yes.
And obviously your collection periods on your debtors,
Yes.
trade receivables. And then for creditors, try and get a longer credit term.
Good.
So your average payment period is to be long,
Nice.
but obviously without incurring additional costs.
Perfect. Well done. So you've addressed 3 of those 4 components: debtors, creditors, and inventory. Right. You'll see UNISA actually covers those 3 in a unit. Okay. So specifically discussing the debtors and the creditors and the inventory and how one should manage those categories within the organization. So the whole focus is to make sure that the cycle never ever stops cycling. In other words, you have cash. In order to create profit, you need to convert that cash into something else. So here we spoke about the cash transformation cycle. All right. If you're drawing a diagram, the diagram is going to look something like this as a basic summary. Obviously, there could be maybe a few more steps or a few less steps depending on how complex the business is or how simple the business is. The most important thing to take away is if you've got cash, that cash cannot be used to create value. In other words, on its own, it's not valuable. Right? That cash needs to be used as part of a business's operations. In other words, we need cash to pay off creditors. We need creditors to supply us with inventory. And because we have that inventory, we can sell that to a debtor at a profit. Right? And once we've collected our outstanding debtors, we're going to then materialize or create cash again. Right? So cash is something that is transformed. Okay, it's used as a tool cash itself is not really that valuable. I mean, cash nowadays is all perceived value. If you look at the notes and the coins that we use today, it's just perceived value. We perceive value. We believe that we can exchange those notes and coins in the future. And that's why we don't mind accepting it or receiving it or even transacting with it. So it's all related to this whole idea of transformation. In other words, taking something that's, inverted commas, like not really worth anything, but then converting it into something that's more valuable that can then be used to materialize or to create more cash, and then the business will continue operating. All right, so maybe you've studied accounting and you've covered cash flow statements. In a cash flow statement, you have three key, let me call them categories, right? The first is obviously operating activities, the second is financing activities, and then the last is investing activities. And that's where cash is utilized from an accounting point of view. Right, but when we're looking at financial management and we're looking at a cash conversion cycle, we're looking at how quickly or slowly does this transformation happen. In other words, when we're looking at that initial cash that we start with, it doesn't matter where that cash came from. It could have come from savings, it could have come from investors or shareholders, or even from loans, debts. We're going to be using that cash and we're going to be transforming it and creating some sort of value in the process. All right, so general cash process, obviously inflows and outflows. Right, we're going to be receiving money from debtors, we're going to be paying money to creditors. Right, so when we're looking at cash, we need to manage those receipts and payments. And as you said, debtors, you want those debtors to pay you sooner rather than later. And you would definitely prefer creditors that give you more time to pay, right? Maybe longer credit terms, right? So good answer. Thank you for covering that from the previous session. I'm going to continue now and just look at the next slide. We've got two questions here about companies. Are they all created equal? What do you think? Do all companies have the same cash conversion cycle?
No.
Definitely not. All right, some industries are more fast moving and cash is generated very quickly. Other industries could be a bit slower, where cash isn't generated as quickly, and it might take a bit more time for businesses to generate that cash flow. All right, so when we're looking at any company, we need to always analyze its cash conversion cycle. And in UNISA test type questions, you'll see sometimes they might even give you a cash conversion cycle for the industry or a cash conversion cycle for a competitor, or it could be the cash conversion cycle for the company but for a prior year. And taking that previous measure of the triple C, you can actually use that as a gauge or a measure or a benchmark to then make a decision on have things improved or deteriorated if we're looking at the current cash conversion cycle. Right, so what determines the time or the duration? Well, you spoke about the relationships. Right, those arrows that we have on this diagram, that speaks to the time. Right, so when we're looking at the ACP, the average collection period is the time that the debtors take to pay us. In other words, debtors becoming cash again. You also spoke about the average payment period, APP. APP would be the time that we take, in other words, using our cash and paying those creditors. Right, and then you also get things like inventory turnover or the average age of inventory, and that would be looking at how quickly or slowly you sell your stock. Right, so there's a lot of different measures that can be used to indicate the amount of time or duration that's needed in order to complete that cycle. Right, and all of those components are going to be grouped into a formula. All right, so these are the two equations that you need. I'm just going to highlight this one in a different color. The operating cycle is the AAI plus the ACP. Right, so when I'm looking at triple C, okay, you can actually expand on this. Right, you could replace the OC, which is the operating cycle, okay, with AAI and ACP, so you have all three components in one. All right, so cash conversion cycle, you can use this formula, is the operating cycle less the average payment period. Okay, why would you, or let's think about it intuitively, why are you subtracting the ACP? Why would that decrease your cash conversion cycle? Any idea? Think about it. The cash conversion cycle is the total time that it takes you to convert cash back into cash, obviously going through the average age of inventory, so how much time it takes you to sell stock, and then how long it takes you to collect the debtors. So why is there a minus here? Any idea? Why do you subtract the ACP? Who does it relate to? ACP? Not ACP,
AC.
so APP? APP relates to?
It relates to your
Which category?
creditors.
Correct. Okay, so if you're looking at creditors, creditors is a form of financing. All right, this is something that you'll see towards the end of the chapter or the module, where they talk about those non-current liabilities and current liabilities. Right. Obviously, the focus in this module is looking at current liabilities. Creditors is a current liability. It's actually a form of financing. Right. So if I can secure really good or positive credit terms, that's going to increase my average payment period, which would ultimately decrease my cash conversion cycle. Right, so you'll see that on the next slide, where we have a combination where we're combining this, okay, formula for OC, okay, and we're putting all three components in one. Right, so remember the diagram. Cash is calculated, or the timing, the cash conversion cycle is calculated using these three key measures. AAI is speaking to this one, inventory. ACP is speaking to this one, the debtors. And the last one, APP, is looking at the creditors. So you need those three in order to get the final formula, which looks like this. All right, there's the equation. Right, and that's the one that I would be using in an exam. Okay. Obviously, if the exam is very specific and they say calculate OC, in other words, operating cycle, then I'm only going to be looking at that. All right. So the diagram here is just to show you what measures we're going to be looking at in terms of your timing. Okay. So AAI is looking at the time that it takes you to sell goods. So if I buy goods, okay, and it takes me 70 days to sell, all right, that's where I am currently. Right. So when I'm looking at AAI, it's a measure of time that it takes for you to buy stock or to acquire stock or to source it, okay, and then sell it. Right. If I'm looking at ACP, that's looking at the collection. Right. So you can see this diagram here, buying, selling, and collecting. Remember, we're looking at the cash conversion cycle. Right, so initially when I buy stock, there might not even have been any cash flow because you could have purchased that stock on credit. Okay, but you still need to measure the amount of time it takes you to sell the stock, because now you're starting to transform stock into debtors and then debtors into cash. Right, so if you're looking at this point to that point, okay, that's stock becoming debtors and then debtors becoming cash. That's the last part. And if you're looking at operating, if the AI was 70 and the ACP was 40, what would the OC be?
It would be 110.
Perfect. Okay. This is the total operating cycle. In other words, how long it takes me, okay, to operate. Operate meaning I'm doing some sort of work, I'm performing a task, I'm doing activities. Okay, operating, remember, operations, if you've done management, in some of the other modules, they talk about businesses, operations, different activities, and how to manage those things. So this is purely from a cash conversion cycle point of view, okay, our operating cycle. In other words, if I have stock, the stock has to become debtors. That debtor needs to then pay. Takes a total of 110 days. All right. The nice thing about APP is it describes the relationship between you and your creditor when stock is acquired. So for example, let's assume I buy stock, but it's not for cash, it's on credit. Right, if I'm buying stock on credit, then I have a certain amount of time in order to pay. So when I'm looking at this operating cycle, we just said, you acquire stock, you buy it, that stock transforms into debtors, and then debtors pay and you collect cash. Okay? We know that the operating cycle is 110 days because that's the whole process in terms of creating some sort of value, all right, in this particular business. The nice thing about this is if the buyer, or the seller, I should say, if the seller, the creditor in other words, if the creditor gives me 30 days to pay, okay, does that help me or does it harm me? Well, we spoke about the subtraction, negative, all right? You want this to be higher. The bigger the APP, the smaller the triple C, because if you have more time to pay, when I acquire the stock, I'm not going to need to pay because I have financing terms that I can use to my advantage, and that's the 30 days. Right, so what does that do to the operating cycle? You can see on this diagram, this little section here is providing you with some benefits, right? Because it's buy now and pay later. So do I need any cash in that time frame? The answer is no. I don't need any cash. No cash is needed, right? Because I'm not going to have to pay for that stock. I can buy the stock and pay for it later, right? So this little portion here is the APP. Sorry, I've made a typo here. I see that should be a P. Sorry, APP, not AAP. Right, APP. Right, the APP, the average payment period is 30. Right, so what would the actual cash conversion cycle be in this diagram, in this example?
80.
100%. Good. All right, 80 days. So let's interpret. Let's summarize. What have we done? We've calculated triple C, which is 80 days. Okay, so if we're interpreting what we're actually looking at, we're saying this particular business, every 80 days is able to generate more cash. They're able to convert other components, so debtors, inventory, and creditors, back into cash. And that happens every 80 days. All right, so if you go back to the diagram, let me not close this. I want to go back to this diagram here, there. Okay, for example, if I had 0 cash, okay, what I can do is I can approach a creditor and I can ask them for inventory. I want to buy some inventory from them and I want terms. In other words, I want time. Right, so if I don't have any cash, I can go to a supplier, a creditor, and I can say, well, you've got so much excess stock. Okay, there's lots of stock sitting in a storeroom or a warehouse. Can you give me some of that stock? Give me 100 Rand worth of stock. Please trust me with that stock. If I can't sell it, I'll return it back to you. At least you haven't lost anything. If I can sell the stock, okay, I want time to pay. And they might give you the 30 days to pay. Okay? You had no cash. You started with nothing. All you did is you went to a creditor, you asked them for terms, and they gave you inventory. All right, you have a business here. This is a functioning business. This is a business plan, basically. All right, that 100 Rand worth of inventory, you're going to transform it, you're going to do something with it, you're going to sell it to a debtor for 200 Rand. Okay? That time relates to the AAI. Right, how long it takes you to sell that stock to the debtor. Right, this is the APP, just to add all of it on the diagram. Okay, and the last bit is the ACP. Right, how long does it take me to collect? Right, so I had no money. I sourced inventory from a creditor. Remember, we spoke about that as being a source of funding or finance. Right, creditors are very powerful. Right, you don't have to buy goods or services from those suppliers or for cash. Right, you can buy those goods, you can use those goods, and then you can pay for them later. Right, as long as you manage the APP, the average payment period, Right? You shouldn't be affected by interest and a different and different fees. Right, so the inventory was in the diagram, it was, what was it, 80? No, it wasn't 80. It was 70. Okay, and then this was 40 days. Okay, was that right? Yeah, 70, 40, and 30. That's correct. Right, so looking at this diagram, you can see you had 0 to start with. You bought stock worth 100, okay, from a creditor with the promise to pay. That stock was transformed and sold at a profit to a debtor for 200. Right, if we're looking at the cash flow, okay, what have I done? Well, 70 and 40 is 111. So after 111 days, I have plus 200 Rand. Okay, obviously, I need to pay the creditor in 30 days. So that's going to reduce, okay, my amount of money. I'm going to have to pay them, right? And there might not even be interest because I've paid them on time, right? If I pay late, then they're going to start charging me interest, right? So 200 minus 100 gives you plus 100. And this is what the cash conversion cycle is talking about. The cash conversion cycle is talking about this. Right, how quickly or slowly is a business able to generate its own cash flow? Right, businesses that can generate their own cash flow are called cash cows. Okay, this is a colloquial or like a very jargon word, okay, used to describe businesses that have positive cash. They have a positive cash conversion cycle, a quick cash conversion cycle that generates positive cash flow. Right, those are businesses that are sustainable, that can continue operating. Right, so remember, it's not about generating a profit or a loss. It's about maintaining positive cash flow. Right, businesses that can generate cash and they can generate cash quickly. Those are businesses that will be more sustainable than other businesses that don't. Okay, understand the concept. Is that all right?
Yes.
Okay,
Yes.
perfect. Right. It's important to understand what you're doing so that when you get to test type questions, then you can relate the theory to that scenario. Right. The nice thing about Triple C is it's going to come up as a working. All right. So if you have the formula, if you've got those equations, it's literally just a matter of reading the information and pulling out the correct components. In other words, the time. Right. How long does it take you to pay the creditor? How long does it take you to collect from the debtor? And how long does it take you to sell your inventory? Right, this is another important note in terms of funding. So once you've calculated the Triple C, now there's a consideration here in terms of funding. Right, there are permanent funding requirements and there are seasonal funding requirements that a business needs to provide for. Okay, so what's the difference between permanent and seasonal? Well, it's actually quite simple. I've summarized it here. Permanent is the minimum that you're always going to need. Okay. Seasonal is the fluctuation, the little bit more or the little bit less, all right, that can arise in a situation, in a scenario. All right, there's a really great example in the textbook. Let me just check the page number. It might have changed because of the different version. Okay, we're looking at the cash conversion cycle. Right, let's just make sure we have the right. Okay, yeah, it might have changed. This is probably 582. Let's just go to that page and just see if it's the right reference.
I think it's 588.
Did you find it? 588. Let's check that.
I think so.
588. Funding requirements, 100%, yeah. Okay, let me just update that. Okay, 588 in the second edition. Right, so just some notes. Right, if you look at that diagram, I'm just going to quickly discuss it just so that you have an idea. Right, I've sent you a few past papers in the past where we've done workings and calculations here looking at this type of situation where you have permanent and seasonal funding. Right, let me draw on the diagram on the slide here just so I can speak to the concepts that are being addressed. Okay, so First thing we need to look at when you're doing a calculation looking at permanent, okay, let me start with black actually, and then I will insert the color. Okay, so obviously you've got time. Okay, so you'll have different months, maybe January all the way through to December. Right, businesses obviously have various seasonal requirements during the year. Right, if you look at the diagram, you can see they talk about this minimum need, okay, which is the permanent funding. So if you're looking at cash conversion cycle and you're looking at the business's ability to generate cash, okay, they're always going to need this 1.35 million. No, 300, not 300, 135,000. Okay, these are small numbers, right? So 135,000 is the permanent requirement that's needed, okay? And that's what they're going to be needing every single month, irrespective of what's happening in the business. In terms of funding, remember we said businesses need to have enough money on hand so they can continue operating. As soon as they run out of money, then they fall into distress. They become technically insolvent. They could become insolvent, technically insolvent. Okay, they're not solvent, and they can obviously file for bankruptcy if things get quite bad. Right, all businesses need this minimum. Okay, minimum meaning the smallest possible amount that I need. Right, and then you'll see in the textbook they've shown you all of these different fluctuations. Okay, obviously there's going to be a high point. Okay, that high point is the peak or the maximum. Okay, and then the seasonal is basically an average of the difference. Okay, in other words, you're going to be adding up all the amounts, okay, from January all the way through to December. All right, you're going to work out the difference. Remember, the seasonal is always the difference. So it's not taking the minimum or the permanent into consideration, it's just the difference. Okay, so don't worry about the seasonal. Okay, it's always given in an exam, okay, and it'll be generally given in a table. Okay, when UNISA gives you a question relating to these funding requirements, okay, they need to tell you exactly how much is required in each period. Okay, when you're doing the working, just remember you're taking an average of all of these fluctuations. Okay, you can't just use one, for example, that one. You can't use that one and say, okay, I'm going to need the extra, the maximum is 1125. Okay, that's 1.125 million, right? And then obviously the bottom, the lowest point is 135,000. Right, that seasonal is going to be calculated using an average. Okay, you're going to be taking the seasonal here, the seasonal there, the seasonal in every month, and then you're going to be working out an average. All right, is that all right?
Yes.
Okay, I think they might even have shown you those amounts, did they? Okay, no, they've just given you a diagram. In the actual example 15.2, I see they have given you a few specific amounts. All right, have a look at some of the past papers. You will see these type of questions, and you'll see the workings. I've tried to make the workings quite detailed, so you'll be able to address it. Remember, you still have a Q&A session that I'm going to host maybe the week before or 2 weeks before. You just need to confirm when is the exam date, okay? And then once you've confirmed that, we can plan either for the week before the exam or 2 weeks before the exam, just in terms of Q&A, and then you can bring any questions along to that session, and I can answer anything that you want me to before you write the exam. Okay, so I'm going to leave those more practical questions for later. Just have a look at the past papers that I've provided, and then you'll see it's actually quite a simple working. But as I said, if you get stuck, then just bring it to that next Q&A session, and then I'll discuss it in more detail if you are still struggling. Okay.
Okay.
All right. Let's continue. Okay. Now we've got aggressive versus conservative. Please note that this is separate. This has nothing to do, okay, with permanent funding. It's a separate consideration. Right, when you're looking at an aggressive or conservative funding, this is a strategy that needs to be applied. Okay, so earlier we said businesses have funding requirements. Businesses need permanent money, in other words, money that's minimum, a minimum amount of it. Okay, and then there'll be a seasonal, which is a maximum amount that they will need, an additional surplus. Right, so we just looked at the diagram. Okay, we know what the funding is. Remember, funding requirements talk about the amount of money that the business needs. Here, we're not looking at how much they need. Here, we're looking at sourcing the funding. In other words, getting the money, acquiring the funding. Does that make sense? This is a separate consideration. All right, you need to know how much money you need. Then you need to know how you're going to get it. Okay, so this is looking at funding, not funding requirements. Okay, students sometimes make a mistake here, and they're thinking these two things are the same. They're different. Okay, so permanent and seasonal funding requirements tell you how much money you need. The aggressive or conservative funding strategies tell you how you should go about sourcing that capital. Right, and when you're looking at this particular section, it's very similar to what you've done in some of your other modules where you look at costs. Okay, so when you're looking at these funding strategies, we're going to be looking at costs, and we're going to be looking at reducing or minimizing those costs as much as possible. Okay, let's first understand what the strategies entail. Right, an aggressive funding strategy looks at utilizing both short-term and long-term debt. Conservative is everything is going to be funded using long-term debt. All right, so again, just to draw a little diagram, you had the little picture, you've got the minimum, which is the permanent. Okay, then you've got all of the fluctuations, which gives you the seasonal as an average. Okay, when we're looking at this aggressive and conservative funding strategy, you will know how much money you're requiring in terms of your requirements. Okay, the permanent and the seasonal. Okay, if I'm looking at a conservative approach, just think about it logically. Conservative means we're low risk. Okay, so if you're looking at a practical scenario, right, as an individual, you don't want to run out of money and then you're going to have to go find it somehow. Okay, then you're going to have to go beg, borrow, and steal perhaps to try and make sure you have enough money to operate. That's bad. Okay, no business wants to get into a scenario where they run out of money and that's a problem. All right, so businesses need to fund their requirements. If I'm looking at a conservative approach, I never, ever want to have to go look for more money. I want to make sure that I always have enough on hand. Okay, and that's why your seasonal and your permanent requirements are both funded using long-term debts. Okay, it's a low-risk approach. It's a conservative approach, so you'll never, ever run out of money. Okay, does that make sense?
Yes.
Right, if you're looking at an aggressive funding strategy, that means you're only going to be using, okay, long-term finance for permanent requirements. Right, so this permanent requirement here, right, I'm going to take out a long-term loan to make sure I always have enough permanent funding. Right, because long-term debt is for the long-term. Long-term debt should be used to finance permanent requirements because that's long-term in nature. Right, we're looking at meeting long-term requirements with long-term debt. If it's short-term, I'm going to worry about that as and when things materialize. All right, so short-term debt for seasonal. Okay, because remember, seasonal could be low here, and then in December, January, or end of the year, November, December, it spikes because of maybe Christmas, and then we need to obviously source more capital to keep the business running. Right, so those seasonal requirements, we're not going to worry about money until it becomes a necessity. In other words, when I actually need it. So that's the seasonal. Right, again, in the textbook, okay, it's just after your diagram, okay, it's on page 589. On page 589, you have the permanent and seasonal funding. Right, just to use this example, again, just as a talking point, if you look at the example, okay, you will see cost of short-term financing. Okay, remember the aggressive policy is using short-term debt to fund your seasonal requirements and long-term debt to finance your permanent requirements, right? If you look at the workings, and this UNISA will give you, right? It's just a calculation. All of this information will be given in the question, right? It's actually quite easy to calculate, right? Again, when you look at past papers, you'll see the calculations, you'll see the workings. It's not a difficult exercise. You just need to remember the theory, right? Aggressive means you've got two costs. You've got cost for the long-term debt and you've got cost for the short-term debt. If I look at the total cost, you'll see here in the textbook on page 589, cost of short-term financing came out to 6,328.13. Cost of the long-term financing came out to 10,800. Right, and you've got an aggressive strategy costing you a total of 17,128.13. Okay, remember, this is looking at costs. Okay, we're looking at costs. Okay. Right, next, the conservative strategy. Right, the nice thing about the conservative strategy, just to add an additional note here, right, if I'm getting lots of money, okay, to take care of my seasonal and permanent requirements, do you agree, if I'm sourcing all of it, in other words, everything, I'm always going to have surplus. Okay, that's surplus money because it's conservative. Remember, conservative means you're going to have lots of money lying around in the business to finance or to meet your seasonal and permanent requirements, so you never, ever, ever run out of it. Obviously, if I'm going to be taking out lots of debt, long-term debt, there's going to be a certain amount of surplus that I can invest. Right, and that's why when you're doing a calculation here, you'll see there's an amount here, a surplus balance that is reinvested at a specific rate to reduce the cost of financing, right? Because if I'm taking out long-term debt, I'm going to have a total amount, okay? Seasonal and permanent requirements are being met because I have a total amount of funding that's being acquired using long-term debt, okay? I'm only going to be using some of it when I need it, right? So there's going to be no short-term financing. Remember we said conservative, everything is long-term. Right, there's no short term, so that'll always be zero. Your cost of the long-term financing, which is the total, okay, that's the peak. Okay, maybe I'm just going to put a note here. Peak, the most, the max. Okay, just to make that clear. Right, so the total long-term financing will always be the maximum. In other words, the limit. If we go back to the diagram, okay, you'll see in the diagram, the peak in this diagram was 1125, okay, 1.125 million. Right, this business never, ever, 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 ever needs more than 1.125 million to operate. So if I'm looking at the conservative strategy, what am I going to do? I'm going to fund the 1.125 million to make sure I never, ever, 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 ever need more money. Right, does it make sense?
Yes.
Okay, obviously, if you're going to be funding the full amount, okay, remember we spoke about permanent? The permanent was how much? What is the permanent?
It was 135,000.
135,000, good. What is the seasonal? Okay, the seasonal, you need to go look at the question. The seasonal need is the average. Okay, in the diagram, we didn't write this down earlier. I just drew this diagram and I just did this and I did this and I said average here. Okay, I didn't write in an amount. I'm going to write in the amount. This comes from a table. They give it to you as 101, 250. Okay, that's in the diagram. It's one example. Okay, just being spoken about in two different application questions. Okay, this is funding. All right, so this is the average. Remember, what is this? This is seasonal. Okay, so when you're looking at this conservative approach, right, you're funding everything, which is the total, okay, and there's obviously going to be some sort of seasonal requirements that are needed, okay, so if you're looking at the earnings, in other words, the average, how much are you going to be saving, right, remember saving is looking at that additional surplus that you're going to be investing. Right, so if I'm looking at my seasonal requirements, okay, my seasonal requirements, the peak was 1125, okay, the permanent was 135, okay, and we have a seasonal of 101,250. Okay, those three amounts are necessary in order to calculate the assumed surplus that will be invested. Okay, so let's work it out. I'm going to use a highlight here. On your calculator, if you take 1.125 million and you subtract the permanent, okay, that's going to give you this in between, this gap. Okay, the maximum and the permanent, that's going to give you the in between. Does it make sense?
Yes.
Okay, so quickly work that out. 1.125 million divided by 135,000 gives you how much?
$8,333.
8,000?
Is it divided by?
No, you're not dividing, you're subtracting. Let me grab my calculator. Let me also do the working. 1125 minus 135 gives you 990,000. Check your maths, be careful. Be careful. Okay, I'm not too sure what you're doing wrong there. This amount minus that amount gives me 990.
Yes.
Okay, did you get that?
Yes.
Okay, what is this saying? What is this representing? Let's think about it. Remember the top and the bottom? Okay, this 990 is looking at this additional potential surplus that's going to be created because I'm funding my permanent requirements with long-term debt. So I'm acquiring 1.125 million as a total. I know I'm going to need the 135,000 every single month, so I'm not going to take that into consideration. Okay, this last bit, the average seasonal requirements. Okay, some months I might use a bit more, some months I might use a bit less. This is the average. Okay, this average needs to be taken out because during this time frame you are going to be using on average 101,250. So subtract that. What do you get as an answer? Okay, on my calculator I'm going to subtract again. 101.25. What do you get?
888.
Good. 750, right?
750, yes.
Okay, this is the surplus.
Okay.
Okay, that surplus is what we're going to be using in the conservative strategy. In other words, the inverted commas, the assumed savings or the assumed investments that I'm going to be getting because I've got all this money sitting around. Okay, remember conservative means take out all the cash, 1.125 million. All right, so I never, ever, ever run out of it. Okay, the assumed surplus or saving is going to be calculated on this additional finance, right? Because this is the in-between. Okay, some months I might save a bit more, some months I might save a bit less. It all depends on the seasonal funding requirements. But on average, I'm going to have 888,750 Rand, okay, invested in a savings account generating interest. Right, and that's why in the textbook they've given you that additional earnings on surplus balances, which decreases the cost of financing that particular strategy. Does it make sense?
Yes.
Okay. Obviously, at the end of all of this, you're going to have a decision. The aggressive in this example is 17,128. The conservative in this example is 45,462. Okay, which is bigger? The conservative. So which is more expensive? The conservative. Which is cheaper? The aggressive. So which option is better here? If we're looking at our funding requirements, which strategy is better for our business?
The aggressive.
Definitely. The aggressive because it has a lower cost. Does that make sense?
Yes.
Okay, and that's how you make a decision. Right. The reason why I'm using these examples is because, remember, UNISA is prescribing this textbook. They have to use the content in the textbook. Hopefully, they've improved the module. A few years back, when students were doing this module, there were some issues that we had picked up in like the assignment or in certain like questions where they hadn't worked out the amount correctly, and then we raised those points and we referenced the textbook. Okay, so the point that I'm trying to make is use the textbook, use it as a guide. Right, UNISA cannot dispute the workings, okay, the process in order to get to the right answer. If you follow the correct approach, you will get working marks, and you should also get the answers in terms of the solution that they provide in the memo. Okay, so just stick to the process, same as FIN3701. Those formulas are important. You've got a formula for initial investment, OCF, TCF, etc. Follow the right approach. Okay, you've got a format or an approach for aggressive and conservative. Follow the method. Right. Just remember, seasonal and funding, seasonal and permanent are requirements, and then the funding is looking at the acquisition of finance. How do I acquire more finance in order to operate? Okay, happy with this bit?
Yes.
Okay, this is definitely going to come up. I've always seen a question come up in every single past paper. There's no way that you can run away from this type of question. All right, the last bit, just some theory here. We spoke about it earlier, so I'm not going to spend too much time on this. You actually gave me these answers earlier when I asked you about your diagram. Okay, you told me inventory needs to be sold as quickly as possible. So the turnover needs to be quick. You also told me that the debtors or the trade receivables needs to be quick. In other words, we need to collect quicker rather than later, right? Sooner rather than later. Quicker is better than slower. Okay. Paying our average payment, APP, the average payment period, when I'm looking at creditors or trade and other payables, I want to pay as slow as possible. Right? So here, you want to delay it as much as possible. You want to try get better terms. And then obviously the last one is looking at general admin, right? Processing and clearing time. Right? That speaks more to the internal operations of the business. All right, happy with that section?
Yes.
Good. Okay, we've got a nice one here. It's a short one. There's just one equation that we need to look at, or actually two, if we also look at reorder point. I don't think reorder point was given in this one, yeah. EOQ is the only one. Right, I think EOQ you've even looked at last time when you did FIN3701, if I'm not mistaken. Does EOQ mean anything to you, or is this the first time you're seeing it?
I think it's the first time I'm seeing it.
Okay, all right, then that's fine. I know sometimes they bring in EOQ in other modules as well. Was it FIN370? No, FIN2601? Not sure either. Can't remember. But EOQ is an equation. Okay, we're going to look at it. Let's have a look at the theory first, and then we can jump into the calculation. Right, remember we're still looking at the cash conversion cycle, but now we're diving into a specific area. Okay, we had the diagram. Okay, we have 4 steps. Right, we're looking at the inventory step. We're going to magnify this step, and we're going to look at better managing inventory. Right, inventory, what is it?
Raw materials.
Yes, or?
Finished products.
Definitely, good. Right, so if you're looking at inventory, what are some of the advantages and disadvantages of inventory management? In other words, why do we need to manage the stock?
Well, because if we have good management, then the quicker we can sell them and get rid of them.
Okay, so you're looking about the sales side, that's fine. But what about the stock that we need to keep in our store? Think about it. If you're keeping lots of the stock, how is that going to affect your business? Don't think about the sales, think about the opposite. What's the opposite of a sale?
Buying.
No, the cost of sale, right?
Oh, okay.
Okay, so if you're looking at a sale, every sale has a cost of sale, right?
Yes.
So if I'm looking at inventory management, I need to look at the inventory related costs
So it's going
of,
to increase.
well, they could, certain costs can increase and certain costs will decrease. It depends on
Okay.
how I manage stock.
Okay.
Okay, so what two categories of cost do you have when you're looking at inventory? You're on the right track. Think about stock.
Cost.
What cost do I have that linked to the inventory? So if I'm buying and selling stock, obviously I need to keep it. Okay, so what costs will I have?
Um, like storage
Well
costs.
done. Okay, we call those holding costs.
Okay.
Okay, holding costs, and the other group is called order costs. Right, there's holding costs and order costs. Those are the two costs that I need to look at when I'm looking at inventory. All right. The role of the manager is to manage every aspect of the business. All right. There are different managers that manage different things. Right. If I'm looking at inventory management, I'm focusing on maybe procurement, so purchasing, right, and maybe operations in terms of manufacturing. Right, those are two areas where inventory will be utilized. Those inventory considerations need to be addressed with those specific managers. Right, so what are those managers going to be doing? Well, if you've done management accounting, so MAC, okay, management accounting looks at all of these different costing things. ABC costing, traditional costing, just in time, etc. Okay, luckily in this module, you don't have to worry about the management accounting. You need to focus on the financial management. This is something that's going to come up. This is the calculation. Okay, you need to calculate EOQ. You need to minimize your holding and your ordering costs. Okay, I'm going to explain what that means in a bit. Right, there's a diagram that we'll look at that explains the trend. Okay, the relationship between inventory and holding costs and inventory and ordering costs. Right, this is theory. I have seen it come up in a theory question where UNISA has asked you to talk about just in time and how it will help a business. If you're buying stock just in time, so when you need the stock, which cost does that eliminate?
Holding costs.
Perfect. Just in time creates zero holding costs because you'll never, ever, ever have to store the stock. Now, think about something like dairy products. If you're buying yogurt, ice cream, milk, butter, all of those things, right? Those dairy products have very, very high holding costs or storage costs because those items need to be kept cold. If they aren't kept cold, they're going to expire, they're going to go off. It's not going to be very pleasant if I'm going to be selling those goods to the consumer, right? So holding costs can form part of the business's overall operations in terms of costing and managing inventory because we don't want those holding costs to be so high. Right, we don't want to buy like 1 million liters of milk. Where on earth are you going to put 1 million liters of milk? All right, does it make sense?
Yes.
All right, I might be able to take advantage of ordering. So if I had to order 1 million liters of milk, that's going to cost me a lot less. But now I'm going to have such huge ordering costs, such huge holding costs because I've ordered such a lot of milk. Right, so there's a fine balance here between holding and ordering costs. And I'm going to show that to you just now. Right, so we've started the discussion. Costs can be separated into holding or ordering costs. What is included in the ordering cost? Give me some ideas. When you're placing an order, what is included in that order cost?
Admin costs.
Okay, possibly, yeah.
Okay.
What else? Delivery, right?
Delivery, yeah.
Yes, there we go. Right, if we look at holding, we talked about storage, okay, keeping things cold. Right, what other costs could go into holding? Think about keeping stock.
Like rent.
Almost, yeah, insurance. Rent, possibly, but again, depending on your management accounting, you might allocate a cost to this particular item, okay, inventory. Yeah, you might allocate part of the overhead costs. So rent
Okay.
could be an overhead cost. I don't know if you've done any management accounting. Have you done any of that?
No, I haven't.
Okay, yeah. If you've done Mac, there's like direct labor, direct materials, and there's overheads. Okay, overheads need to be allocated to specific items, right? And things like insurance, rent possibly, and other could form part of the holding costs, right? But luckily, you don't have to worry about identifying the holding and ordering costs in terms of categorizing them. This is just a discussion from the textbook. You'll be given the ordering cost and the holding cost in a question. Okay, UNISA will provide you with those measures. You need to now look at the relationship between the two, ordering and holding. The basis of EOQ is to determine the optimal order size for inventory. Right, what do I mean by optimal? Well, I want to reduce the total costs, total inventory costs. I want to reduce them as much as possible. That's what EOQ does. EOQ stands for economic order quantity. Right, remember we said if I place an order, if I place bigger orders, so if I talk about a bulk sale, if I have a bulk sale or a bulk purchase, do you agree my ordering cost will decrease, right?
Yes,
But what's going to happen to my holding costs?
it's gonna increase.
Exactly. Right. If I buy less stock, I'm going to have less holding costs, but I'm going to have higher ordering costs because now I'm going to have to order more and more often. Does that make sense?
Yes.
Okay. So the challenge is finding that perfect. Let me just show the answers here. Let me just erase. Finding the perfect match in terms of holding and ordering costs. Okay, now we're going to look at mathematics. You're going to see a diagram. Okay, here's the diagram. All right, we just spoke about ordering costs. I'm just using some random amounts here just to explain the concepts. Okay, quantity of stock. This is looking at inventory, right? If I buy more inventory, so low to high, okay, my ordering costs are going to decrease. Can you see that?
Yes.
If I'm buying more stock, my holding costs are going to increase. Do you see that?
Yes.
Okay, so if I'm looking at the relationship, ordering costs, is that a direct relationship or an indirect relationship? In other words, when the quantity increases, what happens to the ordering costs?
It decreases.
It decreases. So there's an inverse relationship there. Okay.
Yes.
For holding costs, what's the relationship?
Is it a positive
Yeah, it's
relationship?
direct. Yeah, positive, direct. Okay, it's positively correlated. Obviously, with more stock comes more holding costs. Happy with that?
Yes.
Okay. Inverse relationship in mathematics is a downward sloping graph. Direct relationship in mathematics is an upward sloping graph. If I take holding and ordering costs and I combine them onto one diagram, I'm going to get EOQ as the point of intersection. This is what you're calculating using a formula. Okay, so you don't have to draw a diagram. It's not necessary. Mathematics helps us. If you use the square root, 2 times the demand times the order over the holding costs, that gives you the EOQ based on the demand, the order, and the holding. Right, so there's no need to draw up a diagram. If you did want to draw up a model, technically in the real world, you could look at a model, you could build a model, you could build an Excel spreadsheet, taking all your costs into consideration, your holding and your ordering, and you could build a model that would ultimately give you a diagram that would predict what your economic order quantity is. Luckily, we've got something that's easier. We've got a formula. Right, so in FIN3702, in this particular module, they're going to test you on EOQ. Right, there is a much more advanced formula here where they provide for the, I'm going to talk about time value of money here. Okay, I've summarized the equation. Okay, you don't get tested on the time value of money. If you look at the textbook or even other textbooks, this textbook I think also talks about the carrying cost. Do they mention it here? Okay, no, they just simplified as well. All right. If you do search for carrying costs can also take time value of money into consideration. All right, luckily that's not taken into consideration, so you don't have to worry about it. This is the formula. Okay, your carrying costs or your holding costs and your order costs. That's it. All right, so there's an example here. I want you to calculate what is the EOQ. Remember, what is the economic order quantity? In other words, how much stock do I need to purchase that's going to minimize my ordering and holding costs for that particular business? Right, so grab your calculator. First, substitute the amounts into this formula. Okay, let's do the first one together. You tell me what the units are. How much units do I have here?
1,500.
Good. Okay, so this business requires 1,500 units per year, okay, of this particular item, whatever the item is. How much does it cost them to place an order?
It would be 200 times 1,500.
Okay, so be careful. Right,
Oh.
the ordering cost is per unit.
Okay, so you don't need to because you're already including the unit.
Correct, yes. Right, remember, you're taking units times the cost. Okay, so yeah, please remember that this gives you the total cost.
Yes.
Okay, so please don't double account for it. So yeah, the ordering cost is per unit, and then the demand is the total amount of units you have in the year. Make sense?
Yes.
Okay, so yeah, just be careful with the maths. Make sure that everything relates. Remember, you're going to be using per unit costs here because you've got the total units as part of the calculation.
Okay.
Okay, all right. So far so good. Give me the carrying costs.
300.
Yes. Okay, let's see how good you are with your calculator. Can you use the square root function on your calculator? Is it possible to square root 2 times 1,500 times 200 over 300? Quickly do the working. Let's see if you get the right answer. What do you get?
$2.58.
No.
No.
You should be getting 44.72. Try again. Maybe try do the bracket first. So everything underneath the square root sign needs to be bracketed. On your calculator, 2 times 1,500 times 200 divided by 300 equals, and then square root that number.
44.72.
That's better. Good. Okay, so what does that mean? That means, okay, so let's interpret this. You've calculated 44.72 as the EOQ. EOQ says I'm going to be purchasing 44.72 units. Obviously, because you can't buy a fraction of a unit, you have to round it up. So with EOQ, just remember you have to round it up. So the final answer would actually be 45 units. Okay, so what does EOQ mean? EOQ says, for this particular business, okay, they currently have inventory costs of 2,000. If they want to minimize or reduce those costs further, they would have to purchase goods in batches of 45. Okay, every time they purchase, they need to place an order. Remember, it's an economic order quantity, EOQ. Right, you've probably gone, like, maybe when you go grocery shopping, you probably do the same thing, right? Maybe there's like, I don't know, like a promotion, a bulk sale. You can buy bulk, okay, and you're going to save a little bit, all right? Your question is going to be, well, how much should I buy? If I buy too much, I'm going to have high carrying costs. If I buy too little, then I'm going to have more ordering costs. I need to buy just enough. So the answer that we need to get is, how much is just enough? How much do I need to buy? And the answer is EOQ. EOQ answers that question. It tells you exactly how much stock you must buy to economically, okay, reduce your total order costs and holding costs for inventory. Make sense?
Yes.
Right. So purchasing in batches of 45 for this business is ultimately going to reduce its inventory management costs. Make sense?
Yes.
Okay. And see, this links to Triple C, okay, the cash conversion cycle. Remember, this is one component of the cycle. We look at inventory, right? Even if you're selling inventory quickly, that's only part of the inventory management. You still need to consider acquiring the stock, managing the stock, holding the stock, ordering the stock, and that's something else to consider. Right, so when you go to the, I don't know, maybe you go to a wholesaler, something like Macro, whatever, and you might consider buying bulk. Right, buying bulk might cost you more now, and it might increase your carrying costs, but the order cost will reduce. Obviously, you're not going to buy out the whole factory. You're not going to buy out everything they have on the shelf, because then your carrying costs will be too high, and your order costs will be a lot lower. Right, so it's just something that you need to consider. It's a very practical consideration, but obviously in the context of financial management. Okay, happy with the concept?
Yes.
All right, I have two more examples here. I'm just going to give you the answer just to save time. This one, example 2, the answer is 36.51. Okay, same formula, different question. I'm just going to give you the answer, and then I'm going to move on. You could do these in your own time. Okay, and then example number 2. Okay, you've got that answer. Hey, example 2, 36.51.
Yes.
Okay, the next one is 252.98.
Okay.
Okay, all right. See if you can work this out. If you have any problems, let me know. I will give you a working if you struggle. Okay.
Okay.
Right. Last bit here in terms of workings in this section is the reorder point. Okay. Be careful. Reorder point is not looking at the amount or the quantity. Reorder point is looking at when do I buy. All right. So we've answered one question already. Okay. EOQ is looking at how much do I buy when I buy. Right, that's EOQ. EOQ is the economic order quantity. Right, I don't want to buy too much, otherwise I'm going to be sitting with storage costs, holding costs, carrying costs that are massive. I don't want to buy too little because I'm going to miss out on those benefits when I buy bulk in terms of ordering costs. So if I've got EOQ, I've answered the one question. How much do I need to buy? That's the answer. Second answer that I need to determine is when. When are we going to place an order? When do I actually buy the stock? All right, so to calculate reorder point, you need the days in terms of lead time. Okay, so this would be lead time when you wait for stock. Okay, so days of lead time, meaning how long do I need to wait in order to get the stock? The daily usage is looking at how much am I going to use during that time. Right, that's what reorder point is. Okay, it's a very simple concept. Okay, it's quite easy to calculate. Here's a very basic example highlighting the reorder point calculation. A firm knows that it takes 5 days to place an order and to receive the stock. If 100 units are used every day, then what is the reorder point?
500.
Exactly. It's easy, hey?
Yes.
Okay. What does that mean? This means when stock levels drop to 500 units, then I'm going to place an order at the EOQ quantity. Make sense?
Yes.
And that's how I'm going to manage my business, right? If I do this, I'm going to reduce and minimize inventory costs as much as possible. I'm going to reduce holding costs. I'm going to reduce carrying costs. I'm going to reduce ordering costs. I'm going to reduce all those costs. And I'm only going to buy goods when I need to. Okay, remember, just in time. Right, the reorder point helps you to buy stock just in time. Okay, obviously, just in time theoretically sounds great, but practically it doesn't really work. All right, think about delivery in South Africa. If you're looking at just in time, if you place an order today, you don't know exactly when you're going to get it, and that's the problem. Okay, maybe in more efficient markets, perhaps you can use a just in time approach, but you're actually relying a lot on the supplier. And the delivery needs to be exactly on time because you don't want your operations to be affected. All right, so just remember it's a theory-related question. If they ask you about just in time, it'll probably be in the context of a decision, okay, or a theory question related to inventory. All right, that's it in terms of workings for this chapter. Happy with this one so far?
Yes.
Okay, there's just some notes here regarding just in time. As I said, it's just theory. It's not something that you're going to see in a long calculation question. Okay, just remember it's going to minimize inventory costs and it's going to help you with manufacturing efficiency. This is just something that you need to consider from a theoretical point of view. Okay, have you heard of just in time before? Is this the first time you're hearing it?
It's the first time I'm
Okay,
hearing
interesting.
it.
I know in some operations modules where they look at processes, they also talk about just in time. All right, and then the last slide is just looking at computerized systems. This is just something the textbook talks about where they look at these material requirements planning, MRP. Okay, if you're involved in inventory management, right, import, export, or logistics, right, if you work for a company like Takealot or Amazon or any sort of logistics company, they're always going to want to know how much stock they have on hand. Okay, their whole business is about managing inventory. Right, and nowadays you obviously have computer systems that can help you with this. Right, still good, still okay.
Yes.
Great, right. This is a recap. It's worthwhile stopping now just to highlight the points that we've come across. We've looked at inventory management. Okay, we've looked at the cash conversion cycle. Okay, those are the two new chapters we looked at this week. Right, we've got these smaller chapters here on the right, on the left. Okay, we've covered everything on the right now. Those three chapters, the last three chapters that we need to look at, these talk to those other parts of the cash conversion cycle. Okay, remember the cash conversion cycle we said comprises of cash, inventory, debtors, and creditors. Okay, so last bit, in this module, you've got a section here on the debtors, and then you've got a section here on the creditors. How do we manage them? All right, so don't forget, when you look at working capital, it's all practical day-to-day, it's short-term. Everything we've looked at, previous week and this week, is all focused on short-term. Okay, current assets, current liabilities. Right, the first current asset we need to look at is inventory. We've already looked at one current asset, which was, sorry, I said inventory. We've looked at inventory, which is the current assets, and now we need to look at another, which is your debtors, okay, your trade and other receivables. Right, so let me ask you a quick question. How do companies generate profits? How do you generate profit? How is profit calculated? What is profit equal to?
Well, yeah, when your income is more than your expenses.
Ah, that's good. Okay, so this is the key, that's the focus. All right, so income is the focus here when we're looking at trade and other receivables. All right, profits can be maximized. Okay, how can I increase profit then?
With your finished goods, like converting your finished goods, creating.
Not quite. Think about the income. Think about the sales. What can I do to increase profits?
You can allow more credit.
There we go. That's the answer. Nice. Okay, so income, if you're wanting to generate more profit, then you just need to sell more. All right, I'm sure you've probably heard of it, sales.
Yes.
Okay, sales and marketing, right? Sales and marketing is what drives a business. If you've got good salespeople, they bring in the money. Okay, they bring in the income, right? So if companies want to increase profits, sometimes they offer credit. Okay, credit sales. Why? What does that do? It brings in more income. Does that make sense?
Yes.
Okay, if you offer credit, you're going to have twice or three times or four times as much sales because not everybody can buy goods for cash. So sometimes you need to offer credit, and that's exactly what we're looking at here. All right, so thoughts. If we're selling goods on credit, what risks are we going to have to deal with?
Bad debt.
Nice. Okay, bad debt comes up in the working. That's something we need to consider. What else?
Our credit terms.
No, we're not looking at creditors here, we're looking at debtors.
Okay.
Okay, so what risks are associated? If I'm selling on credit, I agree we could have
Collections.
bad debt. What else could happen?
Our collections periods too long.
Okay, collection relates to bad debt, that's fine. You either collect too late or you don't collect at all. Another one is
Okay.
the inventory. Okay, do you agree if you're selling on credit, you need to invest
Oh, yes.
more into inventory? Do you agree?
Yes.
Okay, because now you're letting your customers buy now and pay later. Right, if you're selling on credit, that's going to affect your inventory. You're going to need to invest more capital. So the textbook
Yes.
talks about investments in debtors or trade receivables. If you're giving other people an option to buy now and pay later, you're going to have to use money to buy the stock, the inventory, to give them. Make sense?
Yes.
Okay. Right, so when we're looking at ACP, we just spoke about it earlier. ACP, we want to make sure that the time that it takes for us to collect is slower or quicker than maybe previous years or competitors, right? So if I'm looking at the ACP, there's two things that we need to consider, right? The time from the sale until the customer makes the payment, right? And we also need to look at the payment and when the money is actually collected. This is just something that they talk about when we're looking at collection. Okay, remember collection? There's two ways to collect. Let me put a note here. Collection, debtors. Okay. Do you agree if you have an outstanding debtor, what must you do?
You need to follow up and
Exactly. Right. That follow up is going to create more like time, or it could add more time. Right. So a debtor, you can collect from them directly, or you can have someone else collect from them for you. Does it make sense?
yes.
Okay, so the textbook also talks about factoring and a few other methods that can help speed up the collection. Right, sometimes you don't have to collect your outstanding debtors, somebody else will collect it for you. That's a process of factoring, okay, where you've got a debt collection company that will do the job for you. All right, but the time is the important bit. It'll either lengthen or shorten the time depending on this management of ACP. Okay, collections aren't always that how can I say, simple. Sometimes collections can be quite complicated, especially if you've got bad debt or you have legal proceedings that need to go through, whatever the case might be. Right, there could be additional time that it takes in order to collect the money. Okay.
Okay.
Right. I'm not going to spend too much time on this. I just want to know your perspective. Okay. You have to give me reasons. Do you think credit is good or bad?
It's good.
Yes. Okay.
Um,
Give us one reason why you say good.
well, because it can increase your sales.
Ah, so if you're managing your credit, it can be good. Right.
Yeah.
Leverage is great when you can do more with less, but the problem with credit is it can become bad. Right.
Okay.
Anything good can become bad. It just depends how much of it you have. So, there's a saying, what everything in moderation, right? So, same thing with debtors. If you have too much debtors, what happens?
Well, there's a risk involved of you not getting that money, but also you're
Exactly.
gonna have to invest more.
Yeah. More debtors means more bad debts. Right. If
Yes.
if you're giving more and more and more and more and more credit, at some point you're going to be giving credit to people that can't pay.
Yeah.
All right. So too much of a good thing can become a bad thing. We need to manage this. So that's why we have this chapter, right? Companies need to do a process or need to go through a process to apply for credit. In other words, not companies, customers need to have a credit application that the company is going to create. So, who determines whether a business gives credit or not? So, if you were, if okay, let me give it context. If you're running a business, okay,
Mhm.
who decides on the credit, the
The
terms, the
business.
conditions?
The business.
Yes, the buyer or the seller, which one?
The seller.
Exactly, good. Right, so companies need to process the credit application. Not all customers are going to be deserving of credit. In the textbook, they talk about the 5 C's of credit: character, capacity, capital, collateral, and conditions. Right, I have seen them test theory and where they have spoken about the 5 C's. This is worthwhile making a note, a reminder, going through the theory. Right, please go read more about these 5 C's of credit. Character is basically the person's identity. In other words, like the age, perhaps. Okay, that could be character. Capacity, all right, looking at the like the scope or the extent to which they can take out credits. All right, capital is more the quantity, how much. Collateral, do they have like assets that can be taken in the event of them defaulting? And then conditions would be the terms and conditions that relate to that agreement. All right, so character and capacity both are quite similar actually, looking at the individual, okay, the person, the credit profile, the credit history, etc. And then these are more specific, like sections in the agreement. Okay, how much capital are you going to be giving them? Do they have collateral that you can repossess? And what are the terms and conditions? All right, please look at that theory. It's worthwhile. It does come up from time to time. Right,
Okay.
everyone, or you're okay so far?
Yes.
Okay. Bit more theory on credit scoring. Again, purely theory from the textbook. Every business needs to have a certain policy. Okay, they talk about a credit policy here. In one of the examples you'll see, they talk about adjusting your credit policy and what impact does that have on your business. Okay, we're going to look at it just now. What effect will change the credit standards? What effects will a changing credit standard have on the business? So in other words, we're changing the policy. Any idea?
It depends. If we increase terms, then it's going to be we have to invest more in inventory.
Okay, that's good. So 3 things we need to look for. The first thing you've already got. Okay. Number 1, investment in debtors. That's something that you need to calculate. What's the next thing? Think about it. Do people always pay?
No, bad debt.
Yes, impact on bad debts. Right? And why did we give out credit in the first place?
To increase our sales.
100%. Okay, the profit. Right, so when you do a calculation, when you're asked about a change in a credit policy, you're needing to work out 3 key components. Okay, I've got an example. You'll see it just now. You've got to look at all 3 of these. Right, the first one is actually increase in sales, profit. Okay, but you mentioned this one first, which is good. Okay, it's fine. That one's actually the more difficult one to calculate. The bad debt is quite easy. It's either going to increase or decrease the bad debt depending on whether you're changing the credit standards for the good or for the bad. Right, if you tighten your credit standards, in other words, if you make it more difficult for people to take out credit, you could reduce your bad debts. Okay? If you make it easier for people to take out credit, then you could increase your bad debt. All right, so there could be a positive or a negative effect. It depends on what the decision is. Okay, so let's have a look at the calculation. All right, again, I've given you a page reference. Let me just update the number. Okay, this is looking at the debtors. Okay, the 5C's is on page 596. Okay, the example is on page 597. Okay, this is from 597. Determining the cost of marginal investment in trade receivables. Okay, this textbook example is talking about Dubé tools, and they're obviously manufacturing and selling goods. Okay, if you go through this example, just to highlight the important points, you will see each of these things are calculated separately. All right, so on this slide, I'm showing you this. the investment in trade receivables. Okay, remember, we just said if you're going to be if you're going to be allowing your customers to buy more goods on credit, you are ultimately going to have to spend more money on your debtors. In other words, invest more money in your inventory because you need to buy stock to sell stock. Okay. If I'm looking at the average investment in trade receivables, you calculate that using the total variable cost of the annual sales. You divide that by the turnover of trade receivables. Just to give you a little note here, this turnover on trade receivables is just your average collection period, okay, but divided by 365. So in other words, the number of times that your trade receivables turns over. Turnover, you've probably heard of inventory turnover. Maybe you remember that from your FIN3702-Crash module. Inventory turnover is how many times do you sell stock during the year. Remember that?
Yes.
Okay. Here, we're looking at the same thing. If you're taking 365 and you're dividing it by the collection period, you're basically saying, okay, during the year, this is how many times I'm going to have to turn over my debtors. In other words, collect. Make sense?
Okay. Yes.
Okay. Luckily, you said last time that you have an open book online assessment. So you'll have these formulas. You don't have to study them, right?
Oh, yes.
Okay, but just bookmark this page. Remember, when you're asked about the investment in trade receivables, you need to use these two formulas.
Okay.
Okay, that's the difficult one. The other one is easy. Okay, so when I'm looking at 297, right? Additional sales is just going to be the increase. I'm going to put some notes here. Or actually, let me just show it. Then I can just go through it with you. Okay, if you read the scenario, they tell you that they're currently selling products for 100 Rand. The sales, all on credit for last year, was 6,000 units. Okay. If you read a bit further on, they say the firm is currently contemplating a relaxation of credit standards. Okay, let's apply the theory. If you're going to relax your credit standards, are you making it easier or more difficult to take out credit?
You're making it easier.
Good. So would you expect more people to take out credit or less?
More.
Good. So would you expect an increase in sales or a decrease?
An increase.
Good. Okay, so if you read the question further, the example tells you that there's a 5% increase in sales. You're now going to sell an additional 3,000 units. Right, so 60,000 units will increase by 5%. You're now going to sell 63,000 units. Okay, if you now do the working, the calculation, looking at the profits, okay, you know that the variable cost per unit is 60. You know that the selling price is 100. So what is the additional profit going to be? Well, 100 minus 60 times 3,000 units. Does that make sense?
Yes.
Okay, that's the increase in sales. Right, this is the additional profit, the profit margin. Okay, each item is sold for 100, each item costs 60. Make sense?
Yes.
Okay, and that's how you calculate it. And it's as simple as that. You don't have to study the workings, just study this format. Okay, so I've given you this format. When I get an exam question that asks me about credit policy, where I'm looking at debtors and creditors, right, or debtors I should say, because we're focusing on the business's point of view, the business is going to have to do these workings. Right, this one is easy. You shouldn't struggle with that. This one is easy. You shouldn't struggle with that. It's this one that needs the formulas. Formulas. Okay, make sense?
Yes.
Right. Those formulas are here. You need those two when you're calculating this middle one. Right. It's not so easy. Right. If you turn over the page, on page 598, you've got those two equations. See, same equations, the ones I just put on the slide. Okay, these slides summarize the content in the textbook as well as the study guide. Okay, please use these correct equations. They're given on page 598. Okay, obviously if you read through the information in the question, okay, you're going to get all of those amounts that we spoke about. The textbook example is very good. Please have a look at it. This is one example you have to look at. Okay, this is a bookmark, NB note. Okay, this is something that you need to go over. It's a very simple example. The workings show it. Right, you have to read the information in the question. Once you've read the information, you'll see they've given you enough information to calculate this. I'm just going to put the summary here, and I'm going to discuss it with you. Right, this amount, okay, is the difference. Okay, so I'm going to explain it. I'm just going to talk to the workings. You can, when you have more time, please go through it in a bit more detail. All right, I'm going to explain it to you so you understand what's happening. Okay, this difference is what's additional. Remember, we just said if I'm going to be selling more goods on credit, I'm going to need more investment in my debtors. Make sense?
Yes.
I'm going to have to buy more stock because I'm selling them stock, and that stock is going to be costing me money. Make sense?
Yes.
Okay, so have a look at their example. On page 598, okay, they tell you currently under the present plan, okay, if you calculate the turnover of trade receivables, in other words, if you take the 365 days a year and you divide that by the 30, which is the current ACP. Okay, remember ACP is how long it takes you to collect. You get the 12.12. Okay, remember the context is, what are we doing here? Are we making it easier or more difficult to take out credit?
Easier.
Exactly. If I make it easier to take out credit, the expectation here is that people are going to pay us later. Right, so under the proposed plan, you can see the duration now has lengthened. Your ACP has gone from 30 days to 45. So now, under the proposed plan, your turnover of trade receivables has decreased. It's now 8.1. Right, 8.1 is under the proposed. Okay. Remember, we're calculating the investment. Let me go back here. Okay, we're calculating the investments. Right, so we've got the 8.1, okay, and we've got the 12.2. That's this. Okay, this is looking at the actual investment, the average investment, which is the rand value. Okay, how do I get that? Well, take the variable cost. The variable costs come from the question. Okay, you will see the template that I've used in my past papers. The past papers that I've done in the past, I've shown you how to work this out. I use Excel and I put the formulas down on the piece of paper, and then I just reference the amounts. Right? If you do it correctly, if you outline everything, write down the sales, write down the variable costs, put everything in on the actual working, and then get the amounts, you can't go wrong. Okay, if you've done the working previously correctly, you will just look for this. Okay, it'll be in your working. Okay, because this is part of your sales. Okay, remember, you need to know how much you're selling and the variable cost because you're calculating the profit. Remember, where? Here. Remember this 120?
Yes.
Okay, that 120 would have been calculated using variable costs. Okay, so you'll have this information. It'll be part of the question. Okay, just take that into consideration, the 8.1 and the 12.2, and that gives you the two amounts. And you can see that the textbook's very good. You can see under the present plan, okay, I'm going to need 295,082. Okay, under the proposed plan, I'm going to need 466,667. Okay, the difference here is the additional investment. And you'll multiply that by the current cost of capital. Okay, that'll always be given. That's the required rate of return. That could have come from a CAP-M calculation, possibly. Right, I've never seen them give you that working as part of this question. Normally, they will give you a rate. They'll tell you the additional investment is going to cost the business a certain amount. Are you with me?
Yes.
Okay. Last bit is just the bad debt. This is also easy. Obviously, if I'm going to be selling more goods on credit, I could potentially have more bad debt. The question said the bad debt was going to rise from, let's go back to the question, page 597. Current bad debt was 1% of sales, and it'll increase to 2% of sales. Do you see that?
Yes.
Okay, the difference is the increase, and that's what I'm going to include there. Right, so let's look at this. Is this good or is this bad? This is good. This is bad. What is the net effect going to be? Well, if you do the calculation, you get that answer. Okay, is that positive or negative?
It's positive.
Correct. So are you going to implement the plan?
Yes.
Yes, you will. Okay, if I implement this plan, in other words, for this particular business, if I give out more credit, the good outweighs the bad, and I can potentially increase my net profit by 28,262. But obviously, this is an expectation. It's never perfect. It's never accurate. We covered budgeting last week, actually, or the week before, right? When we covered budgeting, remember, budgeting is forecasting. This is a forecast. This is a plan. This is an expectation. We're looking at the numbers and we're saying, okay, if bad debt increases from 1% to 2%, right? If my investment increases by 171,585, I can still make that up because my increased sales offsets those negative things. Right. Let's assume if we give out more credit and in reality the bad debt doesn't increase by 1%, it only increases by 0.5%. All right, that will obviously make this decision even better. All right, we could also make it maybe 3%, and we could say, well, if it increases by 3%, is it still worthwhile? Obviously, this amount is going to change based on the expectation in the question, and that's what you're going to have to do. Right, in an exam, for this, I've also seen them test. But remember, okay, so here's a little side note. UNISA is either going to give you a very, very, very long question on this, or they're going to give you a very, very, very long question on the triple C, okay, the cash conversion cycle. Right, it's generally going to be one or the other. Right, it's never both, but it could be. I mean, it all depends on them. Right, but remember, this question on its own could be like 20 marks, 25 marks, maybe even more.
Okay.
Okay, but yeah, this is definitely something important. Some past papers have a long question on this, some past papers don't, but it always comes up somewhere, right? The longer past papers, or not longer, I should say the longer, a question that has this as a longer question, okay, a lot of marks is given to the workings here, right? So show all the workings, follow the process, use those formulas, right? Sales, easy to calculate, bad debt, easy to calculate. Don't forget, this one requires these formulas. Okay, how are we doing? Are we still okay?
Yes.
All right, perfect. Don't worry too much about international considerations. Obviously, if you're buying and selling goods abroad, you're going to have to consider the fluctuations in terms of the rates or the currencies, right? So appreciation versus depreciation. That's something that the textbook talks about, right? The last calculation when looking at trade receivables is the cash discounts. Okay. Earlier in the diagram, what did you tell me about debtors? Do you want to sell debtors quicker or slower? I mean, not sell. Do you want to collect quicker or slower?
Quicker.
Good. You want to collect quicker. Do you agree?
Yes.
Okay. If I'm collecting quicker, that's better. And then creditors, do you want to pay quicker or slower?
Slower.
Slower. Good. All right. So here in this set of notes, we have something called the cost of giving up a discount. Okay. We're looking at the speed in terms of collections. In other words, can I attract or can I incentivize or can I convince my customers to pay early? Right. So when I'm looking at a cash discount, sometimes cash discounts can be an incentive to pay early because it's going to benefit the customer. Sometimes it's not big enough. Sometimes the discount is so small, the cost of giving up the discount is very, very small, and it's not really worth it. Okay, so when you're doing any calculation, this is the formula that's used to calculate the cost of giving up the discounts. Right, it's like an opportunity cost. If you've covered economics, right, this is something that I forego, I give up. Right, so the customer will give up the discount, okay, or the customer will use the discount. Right, if they give up the discount, this is the cost of giving up the discount. Right, so let's have a look at the calculation. Okay, maybe just to ask you a quick question, if you're a customer, if the cost of giving up the discount is too high, okay, will you use the discount or won't you? Remember, think about it as an opportunity cost.
I will use it.
Exactly, you would use it. Good. Okay, so when you're looking at the cost, remember, if the cost is too high, that means, okay, you don't want to lose the discount, because if you lose it, it's going to cost you too much. Okay, your interpretation was good there. All right, so that's something we need to consider. Cost of giving up the discount, CD, which is the discount, over 1 minus the discount, times 365 over N. N is the number of days that I forego. Okay.
Okay.
All right, next slide. We spoke about credit, good or bad. I think we've discussed that already, so I'm not going to mention that. Credit monitoring is important. Okay. ACP. Age analysis is something that I've seen come up in questions where they talk about 30 days, 90 days, 60 days, 120 days, etc. Okay. An age analysis is looking at the outstanding credit. Right, so when you're looking at the average collection period, do you write someone off if they haven't paid you in 30 days?
No.
No. Okay, when do you write someone off?
I think when it's like over 120, not.
Yeah, that's fine. It could be over 120 days. It could be over 180 days, whatever it is. But the point is, when the actual debt is bad, it's written off. In other words,
unpaid.
Yeah, it's unpaid, correct. And it's not ever going to be paid. Maybe the debtor has run away. Maybe the debtor was declared insolvent. There could be multiple factors that give rise to bad debt. But the age analysis is looking at how long has the debtor or the debtors been outstanding for. Right, and obviously some debtors are better than others. Right, one debtor might owe you more than 90 days. One debtor might owe you more than 30 days. Right, you need to manage that relationship because you're the business giving out the credits. Make sense?
Yes.
Good. Right, just to give you some notes here about receipts and disbursements. Okay, we spoke about it earlier. This can come up as a discussion question. I have seen theory questions where they ask you to give advice, give recommendations. What can the business do to speed up the CCC? Or what can the business do to improve its ACP? Or what can the business do to improve its inventory turnover? Whatever it is. Right. So I'm just giving you some points here. If you're looking at managing receipts and disbursements, when you're looking at trade receivables, okay, what can we do to improve our collections? Give me some thoughts. Give me some ideas.
We can give discounts.
Good. Discounts is one. There's one here.
Speeding up our collections.
Payment methods. Offering more payment methods.
Oh.
Okay, giving them more options. So yeah, discounts is good. Payment methods is another. And also communication. Making sure that you follow up. Right, constant reminders. It's like managing any relationship. You need to speak to the customer. You need to make sure that they're paying their debts. Okay. Sometimes customers just don't pay. It's because they haven't been reminded to. It's not because they don't want to pay. It's just because maybe they're too busy or they need the reminder. Is that all right?
Yes.
Okay. Next bit. We're almost there. Okay. Spontaneous liabilities. The last two talk about creditors. So remember we looked at the cash conversion cycle. You had 4 components. Cash we've looked at, inventory we've looked at, debtors we've looked at. We've reached the end. The last section we need to look at is the creditors. Okay, it's a nice section because a lot of it is time value of money. Right? If they give you any loans, okay, you just need to remember principal times rate times time, okay, to work out interest in order to calculate the rate or the amount of interest that's payable on these types of current liabilities. Right, first thing, does everything go according to plan?
No.
Definitely not. Right, so for a company, okay, what can go wrong when managing credits?
It can turn to bad debt.
Okay, forget about debtors now. We're changing focus. We're looking at
Okay.
spontaneous liabilities. We're changing
Okay.
focus. We're looking at creditors. Think about owing people, owing
Yeah.
creditors, owing
If
suppliers.
you don't have enough to pay them.
That's good. Okay, you run out of cash. Okay, or interest rates go up.
Yes,
Okay,
so that increases your,
correct. Yeah, there's a
yeah.
few, right? Luckily, we don't have to worry too much about that. It's more the time value of money that will come up. If I'm looking at these costs, right, when I'm operating, do those costs stay the same?
No.
No. Okay, those costs can change. These are spontaneous liabilities. All right. So spontaneous meaning coming out of the blue. Okay, not things that we've predicted or expected. Right. So there will be very similar to that earlier discussion where we spoke about seasonal funding requirements. Okay, but this is not a seasonal funding requirement. These are spontaneous liabilities, liabilities that can arise that we didn't quite foresee, and we need to provide for them. Right. So, what is a spontaneous liability? Your thoughts? We've kind of described it, but let me hear your view on it.
Costs that you don't plan for or expect.
Ah, that's a nice way of describing it. Yes. Okay. Unexpected. That's a nice way of describing it. You use the same word. Very good. Okay. Normal course of business. So, in other words, these are additional considerations. And I've put a note here: trade and other payables and accruals. So, when you're looking at creditors, okay, remember creditors, if you look at accounting, creditors falls under this grouping, trade and other payables. But you don't only have creditors, right? You also have other payables and accruals. Right, so what are some of the other payables and accruals? Can you think of some of them? In accounting, think back to your accounting.
Accounting is not my strong point.
It's okay. Do you remember any other accruals, any other current liabilities that fall under this category, trade and other payables? We're looking at other payables. I'll give you a clue. Think about billing for water and electricity. When is water and electricity billed
Okay,
generally?
like admin costs.
No, not admin. Accrued
Okay.
expenses.
Okay.
Does that ring a bell? What is an accrued expense? If you're doing finance and investments, you probably would have covered FAC 1601, right?
I think so.
Ooh, okay, it might have been some time ago. You might have forgotten some of it. Okay, an accrued expense is an unpaid expense.
Oh, yes.
Okay, it's not a creditor, it's an unpaid expense. So if I use water and electricity, so I use water and electricity this month, and I have to pay it next month. Make sense?
Yes.
Right, it's an accrued expense for the current month because I haven't paid for it yet.
Yes.
Okay, what factors drive unexpected or spontaneous liabilities? Well, when we're looking at this, we look at the management. Okay, so spontaneous liabilities, those factors, okay, is time, okay, interest, all right? You could also talk about quantity. All right, so when I'm looking at managing and dealing with these spontaneous liabilities, right, I'm looking at 2 different forms of credit. Okay, long term, short term. If it's spontaneous, is it long term or short term?
Short
It's
term.
short term. So is that unsecured or secured?
Unsecured.
Unsecured. Good. Unsecured would be that, the credit card. Secured would be this, the home loan. Make sense?
Yes.
Okay, good. Right, there's the note about trade and other payables. Major source of financing. Why? You've got creditors as the main source of financing. I think I even wrote that down, yes. Okay, under creditors, right, we also have these other spontaneous liabilities that we need to take into consideration. APP is the last component. Okay, APP is going to shorten the CCC, the cash conversion cycle, if the APP is lengthened or longer. Okay, the longer the APP, the shorter the cash conversion cycle. Right, so if I'm looking at APP, okay, what view will we have on APP? In other words, if I'm managing my spontaneous liabilities and I'm focusing on my average payment period, what could affect my average payment period?
Interest.
Good. Okay, talk to me about the interest. If the interest is higher or lower, how does that affect the business?
So if it's higher, it's going to decrease the cash conversion cycle.
Well, interest is an interesting one because that's a cost, that's separate. All right, if they're charging you more interest, the interest isn't really going to affect the period, right? It might affect the period in terms of making you pay before it's due. Because remember,
Okay.
when is interest charged?
Interest is charged when you after your credit, like you don't meet your credit terms. So if you pay
Exactly.
late,
There we go. Okay, late payments attract interest. If you pay on time, do you get charged interest?
no.
No. Okay, if they say pay within 30 days, interest free, then pay on day 30 or pay on day 29. All right, if you're paying on day 31 or 32, then you're getting charged interest. All right, so firms need to look at time. Firms need to look at period. In other words, you need to focus on paying as low as possible or as slow as possible. All right, and avoiding costs. Okay, don't pay late and pay penalties. Don't pay late and pay interest. Right, so paying early is always better than paying late. Right, which is better, longer or shorter?
Longer.
Yes, longer for the creditor and for the debtor?
Shorter.
Shorter. Good. All right. There's a lot of questions on this in your exam. They always have a discussion question looking at the CCC. They might discuss one of the topics, in other words, one of the areas, or they might ask you generally to speak about all of them. Okay, but it's important that you understand these principles. Right. Here's the note about the credit terms. Okay, which terms are better? So let's look at company A and B. Which company do you prefer, A or B?
E.
B, why?
Because you have a longer credit term.
Ah, very good. Okay, that's an easy one to get right. If you look at C and D, which do you think is better? Come, give me your motivation. Which one do you like better?
D.
You like D better? Explain?
Because it's a lower amount and you're getting it for longer.
Interesting. Okay, so you would rather go with someone that offers you less credit than more. Well, you're right, you could. Maybe for you, the time is more important.
Okay.
So you would much rather have more time to pay rather than buying more goods. Sometimes people might want to get access to more credit. They might want more of it. They might want to buy more stock. So maybe they can't or they won't do business with this company because they need more stock. And if this company is
Okay.
only offering them 15,000, well, that's not enough. They might have to do business with that company. Make sense?
Yes.
Okay. But the difference here, it's tricky. It becomes questionable. Why? Because the terms are different. Right. So when you have different credit terms, you need to think about those measurements. Right. Here, we have a discount. Right. You could work out the cost of giving up the discount as a possibility. Right. So there's the cost of giving up the discount. We have an example. Okay. I've given you these terms. Okay. Just to explain the terms, this is a 2% discount within 10 days. And if you don't use the discount in 10 days, then you have to pay the net amount, which is the full amount, in 30 days. That's how you read it. Right. So businesses quote terms like that. 2, 10, net 30. So a 2% discount if you pay within 10 days, and if not, you have 30 days to pay. Right. Can you substitute those values into that formula? Right. Give me amounts. What will my CD be?
2%.
Okay. How do you write 2% as a number?
0.02.
Perfect. Okay. Do I have the working here? No. Let me exit. Oh, okay. I didn't show the working. Okay. I'm going to write it down here, and then you can see it. All right. So on your calculator, please put in 0.02. 0.02. Okay. The N. How do I calculate the N? That's the number of days that are foregone. Right. How many days do I forego if I don't use the discount?
$10.
No.
30.
20. Okay, because remember, think about this. Right, if I use the discount, I pay my supplier. Okay? If I don't use the discount, I have more time to pay them. Right, you don't pay them twice. You either pay them early or you pay them late. Does that make sense?
Yes.
If I pay them early, then I don't have more time. Then I forego 20 days worth of credit. Make sense?
Yes.
Okay, so just remember, maybe make a note here, the number of days that are foregone. The number of days that are foregone is the difference between the full period and the discounted period. Is that okay?
Yes.
Okay, so on your calculator, you've substituted all of that into your calculator. Let's see what answer you get.
Okay.
Just be careful to put brackets here if you're using a scientific calculator. Otherwise, the calculator gets confused. I would put a bracket here in the denominator, and I would put a bracket there in the denominator, and then I would do the working, just to make sure that the calculator gives me the right answer. What do you get?
0.37248.
Perfect. Okay, that's obviously a decimal. How do you convert a decimal to a percentage?
So it's 37.25.
100%, or 24 actually, if you round it down. Okay.
Okay.
All right. Happy with that example?
Yes.
Okay, so let's interpret. Remember, we've just done a calculation. We've spoken about this discount story. Okay, remember, you can get discounts as the business owing the creditor. They can give you a discount. Okay, you can also give a discount to your customer. Remember that. We saw that in the debtors. Okay.
Yes.
Irrespective of which perspective we have, think about what we've calculated. Okay, we've calculated the cost of giving up the discount. So if we don't use the discounts, this effectively costs us 37.24%. Make sense?
Yes.
Okay, and that cost is quite significant. Why? Because is it possible? Can you go get money, okay, cheaper than 37%? Probably. You might be able to take out a loan for 10%. So would you take out a loan at 10% to pay off this earlier? You would, because if you don't, it's going to cost you too much. Does it make sense?
Yes.
All right, so that shows you that in this particular example, this discount, this 2% in 10 days, net 30, is very attractive. That's a good discount to make use of. If I don't use that discount, I'm foregoing a discount that's costing me a lot. Okay, did you follow that point?
Yes. Yes.
Perfect. Right, I've given you 3 more examples here. Just in terms of time, I'm just going to show you the answers and then ask you to please try do these workings in your own time. The answer for
Okay.
example 2 is 8.1%. The answer for number 3 is 22.57%. And the answer for number 4 is 37.24%. Okay, I think that's actually a repeat question, yeah. That looks like the same question. All right, so there's actually only 2 new questions.
Okay.
Okay, yeah, try those, see how you do. You can get these workings. I haven't seen too many of these come up in past papers. Once or twice in some of the previous years, but yeah, it is part of the textbook. It is part of the content, so you do need to know it. If it does come up, just write down that formula, plug in the right values. Just remember the N is the number of days that are foregone. Right, you have to calculate that.
Okay.
Okay. All right, we're doing well. We're almost there. We've got one more section to cover. I'm not going to spend too much time on these theory questions. Right, we know how important it is to pay later. Okay, you've told me that. You started today's session by telling me that we should pay our creditors as late as possible. Right, so you know what the goal is. The goal is to stretch out that payment as far as possible. But are there consequences for not paying?
Yes.
Yes. What are the consequences for not paying?
Additional costs.
Good. Additional costs, interest, penalties, fees, etc. All right. So when you answer this question in an exam, don't say pay as late as possible. Say pay as late as possible without incurring additional interest and charges. Just to be more specific.
Okay.
Okay. All right. Then just a note about accruals. What is an accrual? You've probably seen them in accounting. I gave you one example earlier. I spoke about an accrued expense. Remember that?
Yes.
Okay, an accrued expense is an accrual. So what is an accrual? Give me some answers. What do you think an accrual is?
It's accumulated costs.
Almost. Yes. So cost that I haven't paid for yet. So in other words,
Yes.
liabilities not paid. Something
Yes.
not paid. Make sense?
Yes.
Okay, so when I'm looking at an accrual, the textbook talks about an accrual as a form of financing. Okay, because we have expenses that are, inverted commas, still to be paid. Okay, so let me ask you about water and electricity. Which is better, prepaid water and electricity or water and electricity billed in arrears? From a cash flow point of view, from a accrual principle.
In arrears.
Yes. Using the water and electricity is better because I can pay for it next month. Does it make sense?
Yes.
All right. So in terms of cash flow, that's a form of financing.
Yes.
Right. If you can use something now and pay for it later, that's what an accrual is. An accrual is creating this liability for services or goods that you haven't paid for. Make sense?
Yes.
All right. In a company, what's the biggest accrual that companies use? Remember, we're talking about financial management. We're talking about net working capital. We're talking about managing a business. So in a business, in a company, what's the most common company accrual that they have?
Inventory.
Inventory, almost. Think about operations. Besides stock, besides inventory, what's the next biggest cost that a business needs to manage? Think about your company that you work for. What's the biggest cost that they have on their income statements? Any idea?
Um,
I'll give you a clue. It links to HR.
is it staff, like
Yes,
salary?
payroll,
Okay.
salaries, wages. Good. Okay, why are wages considered an accrual?
Because you paying your staff at the end of the month after
Exactly.
they have rendered their services.
Very, very good. Correct. Okay. Remember we said spontaneous liabilities? A spontaneous liability will arise when you have wages. If somebody works for you today, you're going to have to pay them at the end of the month. You don't pay them at the beginning of the month, right? Okay,
No.
you pay them after they've done their work. So these are services that you've received as a business, but you haven't paid for. That's an accrual. If you could get people to work for you at the beginning of the year, for the whole year, and pay them at the end of the year, is that good? Yeah,
Yes.
that's very good for the company, not very good for the employees, but that's just
Yes.
the concept that we're trying to highlight here in terms of an accrual. An accrual is just that, it's a spontaneous liability that arises. Wages, do wages need to be paid?
Yes.
They have to be paid. Okay, by law, legislation says you have to pay your staff. Okay, if you don't pay your staff, then you have these spontaneous liabilities. And because we're looking at net working capital, we need to manage that. Right, people need to be paid. If people get paid late or if they don't get paid, those workers aren't happy. Right, you're not going to have a very good culture in the business if you're paying your staff late. Make
Yes.
sense?
Yes.
Awesome. Okay, we've got one more set of slides. How are we doing with time? Ooh, okay, I'm going to need another 10 minutes if you don't mind.
That's fine.
Okay, right, I'm going to quickly run through this last set of notes. A lot of it is quite basic because it speaks to time value of money where you're looking at loans. Okay, so here we're looking at unsecured and secured sources of short-term loans. Right, remember we're looking at financing or funding. Funding. Okay, we're looking at sourcing capital. Right, when you're sourcing capital, you need to consider these considerations: interest rates, okay, and different types of products, either unsecured or secured products. You also have commercial paper, okay, that will be like treasury bills, right? NCDs, all right, negotiable certificates of deposit. There are other forms of let me call them financial instruments that can be used to raise capital. Okay, short-term capital to continue operating. Right, the first thing I want to ask you is, do you know what a loan is?
Yes.
Explain.
So, when you don't have funds,
Mm-hmm.
you obviously take out a loan
Yes. So
so
that's
you can get the fund
okay.
for whatever reason
Good. So
you
it's
need it.
borrowing, and that loan will be seen as what type of accounting elements? Asset, liability, income, expense, capital, drawings.
Liability.
Nice. Okay. So you said liability. Liabilities are bad. Bad when they aren't paid. Okay. Do you
Yeah.
agree? When you go apply for a loan at the bank, what does the bank call it?
Um, a debt.
No, they call it credit.
Credit, yeah.
Okay, the bank doesn't use this word. Can you imagine how negative they would sound if they said, okay, come fill out this debt application. We're going to give you more debt. We're going to put you in debt. We're going to give you a debt card. They don't do that, right?
Yeah.
Okay, the reason why they don't do that is because they're managing it. Okay, so credit is good, debt is bad. The only difference between credit and debt is how well you manage it. Does that make sense?
Yes.
Right, if you don't manage your loans, if you don't pay your loans, if you pay late, if you never pay your loans, you're going to end up in debt. Right, so are there different types of loans? There's
Yes.
a lot. Okay, and you'll see some of them in the textbook. How do you feel about credit and debt? What's your perspective? What's your view on it?
Um, I think it's good. because it helps.
Yes, it can help because it's a source of
Yes,
finance and you
yes,
can use it to run the business. Right, remember earlier we said you can approach a creditor to get stock and you've got a business.
yes.
Right, as an individual, same thing. You can use it, but you've got to use it responsibly and you've got to use it for the correct, let's call it reasons. Hey, don't take out loans to pay employees. That's bad. Right, take out loans to buy inventory. Take out loans to maybe invest in the operations of the business. Right, something that will give you future benefits. Right, so when we're looking at unsecured and secured loans, right, the word credit comes from this term. It's a Latin term that's used to describe trust. All right, so if you're looking at debtors and creditors, okay, when we're looking at secured and unsecured loans, this is based on trust. Right, a debtor is when you buy goods and you sell those goods to your customer. Okay, those customers are called your debtors. Right, your creditors, who are they? Who are your creditors?
Um, Creditors are who you are buying from,
Good, buying
or
from.
yeah,
Yes. Okay, so creditors allow buyers to buy goods from them. Okay, so they're the suppliers. Okay, so debtors, remember, customers. Creditors, remember, suppliers. Right. Is there a limit? In other words, is credit limited to debtors and creditors? Do you only have debtors and creditors?
um, I'm not sure.
No, you don't. You have others as well. Right. There's a lot of different forms of credit. Okay, revolving credit agreements, lines of credit. Okay, those are all different options. Okay, overdrafts. All right, so when we're looking at unsecured loans, this is credit granted to the business without collateral. Okay, collateral, we spoke about it earlier. Collateral is security.
Yes,
Okay, if you don't pay off the debt, there's some form of collateral. Here, this is without. All right, so in the textbook, it's on the basis of trust. Okay, remember, there's no additional collateral. Right, so in the textbook, they give you these examples. A bank loan. Okay, that's an obvious one. I'm sure you know what that is. A single note
yes,
for payment, also, that's a commercial product that banks, or not banks, that companies issue. Overdraft facility, all right, having access to funding through maybe a bank account. Revolving credit agreements, okay, having access to this facility on a month-to-month basis instead of having to always apply for it. Commercial paper, that would be something that you would issue, maybe in a stock exchange, okay, like a bond, right? And then international loans, right? Borrowing from other countries. These are just some of the different forms of credit that the textbook takes you through, right? From an exam point of view, I've seen this come up, bank loans. I've seen revolving credit. I can't remember if that one came up. I think it was overdraft. But I know the simpler ones that came up was the interest equals principal times rate times time. Okay, sometimes they do ask you about this, where you've got to do a calculation with time value of money. Right. Luckily, the others aren't so important in terms of your module. Right. I don't think they'll ask you to calculate too many of those. Okay, but there are some formulas that you do need to know. Okay, principal times rate times time is the most obvious one. Right, here we've got a note about secured loans. If it's secured, how is it different to unsecured? What do we have here?
collateral.
Nice. Okay. Here we have pledging trade receivables. So you've got the debtors. Okay, you can give the bank, inverted commas, collateral in the form of debtors. Factoring, I spoke about earlier. I mentioned factoring. You can sell your debtors book. This is where you speed up your collection. Okay, when we spoke about debtors and creditors earlier, remember with debtors, you want to collect sooner rather than later. Right? If you're collecting sooner, that's good. Okay, factoring is where you're selling your debtor's book to a debt collector. You're saying, okay, give me a percentage, maybe give me 60% of the outstanding amount. All right, and then the 40%, you go and collect that. Make sense?
Yes.
Right, that's also something that was mentioned in the textbook. This will come up in theory questions. If they ever ask you about, for example, debtors, how can you speed up or improve your triple C, your cash conversion cycle? You could say, well, debtors can be improved on. A business could make use of factoring. Factoring will allow us to collect money from all our outstanding debtors sooner rather than later, because a debt collector, okay, the factor will pay us for our debtors, and we will receive all that money. Right? I mean, some businesses might have a lot of money outstanding. Let's assume it's a massive business. There's 100 million outstanding, right? And they don't want to wait 60 days, 90 days, 120 days to collect. What they could do is they could go to a factor, right, a business, a debt collector, and they could say, well, give us 60 million today. Okay? The rest you go collect. Right? And they don't mind doing that, because remember, this is the sales. When they sold the goods might have cost them 20 million as a cost of sale. Okay, because remember, everything you sell sells at a profit. Right, so if your cost of sale is 20 and you're selling that at 100, right, and you can get the 60 immediately, right, that might be something to consider. Okay, so just remember, when you're looking at secured and unsecured loans, sometimes you can use those assets. Debtors is an asset. You can use that as a tool to help you with acquiring short-term finance or short-term capital. Okay. Which is better? Do you have a view on this? Which do you think is better?
Maybe secured loans.
Yes. Why?
Well, because you have that collateral.
Good. So if
So
there's collateral there, talk to me about the rates. Talk to me about the interest. Secured loans, interest? Higher or lower?
Is it lower?
Yes, very good. Okay. Right, secured loans always have better interest rates. Right, unsecured loans have higher interest rates. Why? Because there's no collateral. Right, if you have a home loan maybe, or a car finance, right, you're not going to pay as higher, the interest rates on that car finance or home loan finance will be a lot less than if you have a credit card, right, or an overdraft. Make sense?
Yes. Yes.
Okay. Right. There's that formula that I spoke about. Okay. Some of these, okay, so I've just taken the textbook, okay, and I've highlighted certain interest rate calculations that are relevant for certain types of finance. Okay. This is a discount loan. Okay. If you are given any question looking at a discount loan, this is the formula you need to use. The interest rate equals the interest that you pay, the actual amount, divided by the principal or the amount borrowed, less the interest, and that gives you the rate. Sometimes you're asked to calculate the interest rate for these different products, okay, these different financial products. Right, a discount loan, any discount loan, it doesn't matter what it is, any discount loan, the interest rate is calculated using that formula. Right, the interest that's payable, in other words, the amount of interest that's paid, okay, divided by the principal less that amount of interest that's paid. Okay, is that right?
Yes.
Okay, here's the other one. There's those two formulas. Let's put them in red. Right, when you have normal loan scenarios, not discount loans or anything issued at a discount, normal time value of money principles apply. Future value, present value plus interest, interest, principal times rate times time. I should actually add the time here as well. Let me put time in as well. Okay, principal times rate times time. Okay. How's your time value of money? It should be quite good, eh? Because you did your FIN3601.
Yes,
It's
it's
quite good, eh?
pretty, yeah.
Okay, you still know how to use your financial calculator.
Yes.
Okay, that's very good. Okay, I haven't seen that many time value of money calculations coming up in this module, but it's always something that could come up. You never know. We just need to make sure that we have that skill. Okay. All right, those are the other loans that I spoke about. Bank loans, okay, normal, you use simple time value of money. The textbook talks about them as being self-liquidating. What does that mean? Any idea? Think about liquidity. Think about paying off loans. Why would a business call these bank loans self-liquidating?
Because they would be like terminated.
Yes. Okay, a bank loan has a term that ends. Right.
Okay.
It's part of your financing. Right. So if I'm looking at cash, okay, remember getting cash is good. Right. If you have it, you can make use of it. Right. So when you look at the self-liquidating loans, why? Think about your triple C. Think about your debtors. What do debtors do? What do debtors do? They give us money, cash. Do you
Yeah.
agree?
Yes.
Okay, so a bank loan is a source of cash, right? Anything that's going to be giving us cash is going to be good initially when you acquire it, but then later on you're going to pay it off, right? So if I'm looking at taking out a loan, this is an unsecured loan. It's used for seasonal funding requirements. Okay, it's self-liquidating because there's a term. It's going to end, right? But it gives you an inflow initially. It's a loan. Can remember when you take out a loan, what do? You debit the bank and you credit what? The loan,
Yeah.
the liability, right?
Yes.
Okay, this is cash flow. All right, so anything that can improve cash flow is useful and helpful in the business. Right.
Okay.
Single payment notes, once off type loan, short periods of time. Overdraft facilities, where you have access to a certain amount of credit. Remember, it's not guaranteed, right? You have to apply for it. Right? So when you have an overdraft facility, it's applied. There's an application that you need to complete in order to get that facility. A revolving credit agreement is guaranteed. Okay, guaranteed meaning you've met the requirements, it has been granted. Okay, as and when you need more money, you can access it. Right, it's accessible. You don't have to always apply for it. Right, there is a fee though that you have to pay to have that revolving credit agreement in place. Right, but overdrafts, not guaranteed. Revolving credit, guaranteed because you have access to it. It's revolving. You can use it. You can take out the credit, pay it off, and then take out more credit and then pay it off. You don't have to constantly apply for it. Right, commercial paper, something like a treasury bill or a bond that'll be issued at a discount. That's time value of money. Okay, you've seen that a lot in not INV, well INV as well actually, but for the bond one, but you've seen that more in your FIN3701. All right, again, not so important for tests and exams, but it is given in the textbook. International loans, you can take out loans from abroad. Okay, you do need to consider this, the currency or exchange rate risk, right? Because currencies fluctuate, and that's obviously something that businesses need to be aware of when they're transacting in different places around the world. Okay, and I think that covers everything. Last bit here, just a note about collateral. We spoke about collateral. What is collateral?
It's secured.
Good. Security. Security for loans. Security for finance. Right. So you can pledge your trade receivables, your debtors. You can use debtors as a form of collateral. Debtors can also be sold. Right. So when you have factoring, you can sell your debtors book to a debt collector. Inventory as collateral. You can also use this as a form of security. What are we going to use it for? taking out loans, getting short-term finance. Right, so whenever a business is in trouble, right, a business can use its inventory, a business can use its debtors, a business could use any of those inverted commas short-term assets to access short-term finance. Make sense?
Yes.
All right, and that's the whole purpose of this module. It's to teach you how to manage your net working capital. Right, if you get stuck as a business, try to find ways to acquire finance. If you can't take out a loan, maybe consider using inventory as collateral, right, to give the bank or the lender peace of mind. All right, so the lender will have either a trust receipt loan, okay, or a warehouse receipt loan. It depends on who controls the stock. Right, sometimes the bank will say, well, the stock is theirs. If you don't pay off your credit, then they're going to keep your stock. Right, or they could give you a loan based on the value of the stock rather than like who owns the stock. All right, sure.
Okay.
Quite a long one today. Sorry about that.
No
Hopefully you
problem.
managed. All right, I just wanted to make sure we covered everything that we needed to cover for today. At least then we've covered all the content. Important, past papers. Okay, I've mentioned it to you before. The best tip that I can give you from a UNISA perspective is to try get through some of the past papers and see if you can manage those questions, because they do test similar things in future past papers. All right, so Parosha, please let me know when you're writing your exam. Maybe just give me a heads up once you know, and then we can plan just an hour just to go through Q&A. Right, so that Q&A is up to you. You can bring whatever questions you want to, whether it's assignment based or whether it's past paper specific, it doesn't matter, I don't mind. Or even if it's like something that we've covered that you want to maybe go over again, I'll spend an hour just taking questions and answers, either in the week before the exam or 2 weeks before the exam, depending on when it is. Okay. Do you have any date yet for the exam or not yet?
So there is a preliminary exam timetable that has been released.
Okay, that's good. What is the date currently on the preliminary timetable?
Okay, so the date is, I think it's the 27th of October.
27 October, which is a Friday. Okay, that's fine. Then we could probably host the Q&A on that Saturday, the 21st.
Yeah, it's the 27th of October.
27th, eh?
Yes.
Okay, so if we hold a Q&A on 21, that still gives you a full week to prepare for the Friday. That should be all right, eh?
Yes.
Okay, awesome. All right, so try to get through some of those questions, and if you've got others, then you can always go through those as well. Even if it's a question that you've looked at recently, that they maybe have provided you with and you want to run through that, that's also fine. I don't mind doing new questions either. If you've got last year's exam and maybe you want to go through 1 or 2 questions, that's also fine. I really don't mind. It's up to you. So bring whatever you want to, questions. I'm open to any questions that you have regarding the module, and then we can address it. So I'm going to book that provisionally then, 21st. If the date does change, let me know. But I think 21 sounds good. At least that gives you time. And then we can go through anything that you need before the exam.
Okay, cool. Thank you so much, Anthony.
You're very welcome. Thank you again for letting me assist you with the content.
Appreciate it.
Good luck with everything, and then we'll talk again on the 21st.
Okay,
Awesome.
no problem.
Okay,
Thank
then.
you.
Bye, Parosha.
Bye.